So we're going to go through some of the drawbacks to the infinite banking concept or to cash value life insurance, because often we're talking about how great it is. If you design a policy properly, it works very well. And the policy design actually has everything to do with how to properly structure a policy and even the drawbacks. So let's go through that. The main drawback to whole life insurance is this. We talk about this all the time. When I set up a policy with my design, where can my money go? Right? Where can I actually pay dollars into an account, to a life insurance policy? Premium, that's often my insurance expense, or cash. This is my PUA rider. Dollars that go towards the premium, the expense piece. So I'm going to pay in $1,000. Dollars that go into the premium relative to my cash value in at least the first year and sometimes the first and second year. I'm not going to have anything in cash. The reason why is that premium dollars buy me a death benefit. What the whole life insurance policy does, what the company does, is they're going to overcharge me for the cost of insurance on the premium piece. So we want to drive this as low as we can to minimize our expenses. I have 10% because often, especially with the bigger carriers, you'll see that wherever I set my premium, the company will allow me to contribute usually up to 10x that into cash or a total contribution each year. And then obviously dollars that go into my PUA rider, we'll just call it cash, go into cash. So, main point, what's the drawback? This is it. If life insurance, the death benefit, is not my primary concern, if I want to pay money into a policy and see it available right off the bat as much as I can get, the drawback's going to be this premium, because no matter how well we structure a policy in the early years, I'm going to see a negative return. Let's look at a quick example here. So that's it, the drawback, early years, negative return. Here's an account that we have optimized as far as policy design and performance. Is that big enough, that font? Make it a little bigger? A little better? Yeah. All right, cool. So let's just make sure we get everything here. Perfect. Okay. So here is a policy with an individual paying in $25,000 for 4 years. So that's one advantage, is that we do not have to pay into a policy for a long period of time if it's designed properly. Now, of that $25K, again, the policy design, here's my underlying premium. This is my insurance expense. And then here's money going into cash. I do have a small portion of that cash peeled out that purchases my term rider. I'd refer you to our policy design segments if you want more information on that. Here's the drawback right here. So I'm paying in $25,000 a year for 4 years. Nothing thereafter. Under the net after-tax outlay column, that shows how much I'm paying in per year. And then under the cumulative net after-tax outlay column, that tallies up my total contributions. So 100K, that's how much I've paid in total. Now, if I look at my net cash value, that's my money column. Here's your drawback. Year one, I pay in 25. What do I have? Right, very close to 85%, but it's still a negative return. No matter how I slice it, no matter how high the dividend rate is, that's gross rate anyway, I have a negative return in the first year. Now, I pay in 25K year two. I see that growth, more than 25,000 comes back to work for me, 25K and change. So year to year, I have a positive return. But if I look at the overall returns, meaning I want to look at this column here, cumulative net after tax outlay, by year three, I've paid in 75, and I have 73, almost 74. Very close to positive, and yes, I do have a death benefit. So if I look at it from that perspective, the death benefit didn't cost that much at this point in time. However, if my interest is the cash value, I do have a negative return. Once I finally hit year 4, all right, I'm positive. And I can keep paying into it. It'll get better and better. I've got that option. And now I've got kind of just a high yield savings asset that goes nowhere but up. That's the upside, obviously. So main drawback to this is the early years. When I start a policy, I'm going to have a negative return. If I need access to everything I pay in, I might want to look at something else, or at least use something in conjunction with this, because a cash value policy will not give me access to 100% of my contribution right off the bat. That would be the major drawback to a cash value life insurance policy.